Hey, so welcome to the fourth lecture. Good evening, everybody. Hello. For those who do not know, the TMA results are out. What I mentioned earlier, for those who came a little early, we will go through some broad overview of the TMA at the end of today's lecture. I think we'll have some time, so we'll go through that after the today's lecture. And if you do have any concerns on your TMA, you can raise those questions as well. And one more thing, just before we started today's or started this lecture, I actually uploaded a new set of lecture 4 slides. But they're just in case you have downloaded the old version, don't worry, it's very small minor changes. I'll point them out as we go along, just minor typos. But if you want, you can just download it from our tutorial group. So that's the updated lecture slides. Yeah. Um, okay. Uh, okay, let's start because we have quite a bit to cover in today's lecture, especially towards the end, can be a bit heavy. So let's start today's lecture first, okay? All right. So for today, what we're going to cover is something that we have talked about very briefly in lecture uh, 1, if I'm not wrong, lecture 1. So we will go back to forwards. Okay, so before we start lecture, anyone can recall what is a forward? You can type it in a group chat or feel free to just unmute yourself. What's a forward? Locking future price. Okay, that's good. What are some characteristics over the counter? Yeah, that's right. It's good. Buy and sell predetermined price of the future. That's true. Do you have to pay anything upfront at the start? That's customizable, that's right, compared to futures which are over counter. No payment upfront, yeah, that's right. So there's going to be no payment upfront, right? So just quickly jump back to lecture 1 when we talk about forwards, just to show you a quick recap of how it looks like. So some important points I want to highlight is they do not pay anything upfront. This is the payoff. Um, there are some credit risks involved. Okay. Uh, and one more thing is that the last part is swaps are actually essentially, so this is the part where we talk about lecture 1, swaps are essentially built upon forward contracts. Okay, so these characteristics are quite important because in today's lecture, we're going to cover uh, forward pricing. Then we talk about a bit of swaps and futures. But the end of today's lecture, we're going to cover how to price or value a swap. And that would be the one of the key components of today's lecture, because without a doubt, this would be in some kind of assessment, right? So you have to be very familiar with how do you price a swap. Okay, so let's go back to forward, right? So forward is the building block for our whole derivative module, right? So forward pricing. All right. So in case for those that just came in, just wanted to repeat that I just uploaded a updated set of slides in our tutorial group. They are just very minor edits. So if you have downloaded the old one, it's fine as well. There's not going to be material changes. Okay. So as you can see in this slide, there's a bit of edits here. Okay. So what's forward pricing? So like many of what we talked about in the last lecture, like the pricing bounds or not bounds, sorry, option bounds, we want to try to price the derivatives, right? Like we learned binomial tree method pricing the options. So for forward, we're trying to do the same thing. We're trying to price the forwards. Okay. And we apply this principle of no arbitrage again to price the forward by having two portfolios of assets. So we try the whole concept is we create two portfolios, one involving a forward, one involving an underlying, typically a stock. And then if we know that there's a no arbitrage principle, meaning that both portfolios should be the same if the payoff is the same, right? So because we do not care about any kind of storage cost in this pricing model. Okay, so in the old sales slide, there are some details here. Basically, I shift it to the next slide, right? So suppose you have two portfolios now. Okay, you have two portfolios. First portfolio, you are actually buying underlying stock at, and the current stock price is S naught, right? Stock price now is S naught. On the second portfolio, you buy a forward of asset, and like what you mentioned earlier, a forward has no upfront payment, right? That's why I come ask the first question, what are some characteristics of a forward? So there's no upfront payment in this case. But at the same time, it matures, um, and at maturity, you have to pay the price of the forward, which is F naught at time T, right? So that's the price you have to pay F naught at time T of the forward at maturity. To make sure enough money, you can put your so-called money in a deposit account, which may give you a risk-free rate. So with these two strategy, right, they are equivalent, which means that at time equals to zero, the stock price basically equals to the forward at time t, which is here, forward at time t, and you discount this forward based on the prevailing discount rate, right? You discount it back. And so this should give you the price of the underlying, which is the stock price now. So this is the no arbitrage method where you combine two portfolios. And as you know, you can do like an X-Men method where you cross multiply. So the forward price was equals to basically the stock price compounded by the number of months or years based on the risk-free rate. So this is the pricing of a forward. So we can have a slightly different approach to understanding forward pricing. Again, we consider first buying the forward contract, and then we short the underlying asset. And when we short the asset, we get money, right? We get some money. This money we put into a deposit, which give you R plus 1 or 1 plus R returned to the power of T, right? So that means it's compounded. So we have an example in the next slide to show you what it means. So first you buy a forward, which is first you buy a forward, which you know that a forward you only pay at time T, right? So forward at time T, basically you have to pay, you have to buy the stock, and then you minus the cost of the forward, which is involved, right? So it's ST minus F naught T. This is the first portfolio one. Now for portfolio two, there's two parts to it. The first part is you short the underlying. So when you short the underlying, you get S naught. This is a cash flow, right? This is a cash flow. So you get money, right? You short something, you get money. So it's positive to you. So you at time equals zero, you get S naught. But at the same time, you pick this money. So you take the money and put it into a deposit. So you minus S naught. So net nothing, right? You short, you get the money, and then you take this money and put it in a deposit account. But at time equals to T, basically you need to unwind your short position, meaning you need to pay back your ST, right? So it's a negative cash flow for you on the short position. And at the same time, you know that your S naught has grown by the risk-free rate, right? Depending on the number of years that you have put into a deposit account. So what does this mean is that if you add both portfolio one and portfolio two together, at time equals to zero is zero here, right? No effect. Now at time equals to t, what happens? Let me just erase some of these chicken scribbles. Okay, and so at time equals to t, basically you just add this up. So this cancels out. So what you get is S naught compounded minus the cost of the forward, which is what you see here. So this will become equals to zero, as you can see here. This equals to zero. And so if this equals to zero, you can shift your F minus F naught here. So it becomes F naught T equals to stock S naught compounded. Right? So we have again proven the forward pricing as as we see in this slide here. So there's just two methods of proving this forward pricing. And as you know, you probably seen your TMA already. They will typically not ask you how it's being proved, but more importantly, how you're going to use the formulas that you have kind of learned in the module, right? So the proving will not usually ask. Any questions? So just to take note, your forward pricing can be priced as such, or going back to lecture one, your forward pricing can be priced using your core parity, right? So I'm just going to put a star here. So I hope you can draw the connections between what you have just learned in this forward pricing and your put call parity. Okay, so you have to link them both together. Okay, so for forward pricing, this is just to show you if they are not equal, meaning if the forward price at time t is not equal to stock price compounded, then you have some arbitrage which could happen, right? So if the forward price is more than your stock price compounded, which is given here, more than stock price compounded, then what you can do is at time zero, you simply can buy the cheap asset, right? Because your stock price is less. So you can buy the cheap asset um, by how do you do? You borrow money to buy the stock, right? And at the same time, at the end, you can actually sell your forward contract, which gives you an arbitrage profit at time zero. You can basically you short your forward because your forward give you more money, and then you can use this to buy the cheap stock. At time t, what you can do now is that because you have borrowed money, you have to repay your loan with interest. But at the same time, you can deliver the asset and receive this F naught T, right? And so your profit at the end of the day would be your FT, F naught T minus your stock price. Basically, what we're trying to say here is that because you get more money from here, you can use this money to pay off your S naught and still have additional arbitrage of profit that exists. Okay. On the reverse, this can also, if the forward price is less than the stock price, you also can have an arbitrage profit, where in this case, at time zero, you buy the forward contract, which is cheaper, and then you short the stock and deposit this money in your deposit account, which will earn you interest rate, right? So at the end, at time t, you receive the interest from your deposit, and at the same time, at time t, you pay off your forward because your forward have to be paid at expiry. And so because what you get from this is more than your forward, so you get some profit, which is S naught compounded minus F naught T. Okay, so this is a simple example on forward pricing. So consider a non-dividend paying stock current price at uh, S naught equals to 30. The forward contract is initiated to deliver underlying stock in 1 year. What should be the forward price F naught? So 1 year, right? So remember we have the formula where forward price is simply the stock price compounded. So we just take the stock price and compound it by 1 year. So are forward and future price equal in real life? Typically, we say that it is the same, but this is very theoretical, right? Because theoretically, the price are the same if the risk-free rate remain unchanged. But we know that forwards and futures are different, are same but kind of different as well. You mentioned some of the points. Forward is OTC, future is on the exchange, future is daily mark to market, we should cover in lecture one. So in real life, there might be some differences in the price. Right. So this is just a bit on forward, but then this part is what is going to be very important. So I'm going to highlight you why is this very important, right? Okay. So bond pricing with forward interest rates. So what is this? So does anyone know what is a spot rate curve? What is a spot rate curve? Anyone heard before, or this is the first time you heard what's, or you have never heard what's a spot rate curve before? Never heard, trend line kind of thing. Okay, you are about it's a bit never heard. Okay, never. Okay, so basically maybe no one have heard what's a spot rate curve. Okay, so let's try understand. I will try explain what's a spot rate curve before we go into all this detail. So a spot rate curve, right, is a zero coupon bond. So everyone knows what's a zero coupon bond, right? So it's a bond that gives no coupon. So there's no coupon, meaning that the price you pay now and the price you get later is basically your interest that you get. So let's say if you pay less, maybe you pay 89 now, and you get after a maturity, you get 100 for your bond. That means you have a $2 kind of interest that you get. So there's zero coupon that you get for that 1 or 2 years. So by having a zero coupon bond, basically you can use this zero coupon bond to build a spot rate curve, which basically gives you the interest rates at various times. So if you have a 1 year zero coupon bond, it gives you the interest rate or the risk-free interest rate, typically it represents risk-free interest rate of a 1 year investment. If you have a 2 years zero coupon bond, it gives you a 2 years interest rate. So for example, this is your uh, T, right? And this is your I, right? I is interest. So for example, if you have a 1 year zero coupon bond, let's say the I is here, the interest you get is here, and then your 2 years, 2 years, 3 years, so 1, 2, 3. So for example, if the normal case is a sloping up, right? So your curve, so as the longer your zero coupon bond, the more interest you get. Anyone know why? Why when you have a longer bond, you get more interest? It should be quite intuitive. Anyone just want to mention? Time value of money, compounding effect, yes, but at the same time, you are locking in for a longer time, right? If you go and buy a 5 years bond, you expect to get more money, as in more interest in a typical situation, right? Meaning that your yield curve is not inverted, is not in a weird situation. Now, of course, everyone knows, right? Now in the bond market, your interest rate actually decreases um, when you are in the 30 years bond period because of sentiments. People feel that the future outlook might be worse, so maybe the interest rate is lesser, etc. So there are or the inflation will change in the future, so interest rate lesser. So but this is an inverted bond uh, spot rate curve situation. But in the normal case, the longer it is, the more interest you get. Okay, we talk about typical case. Okay, so again, I repeat. So what is a spot rate curve? So a spot rate curve, right, in layman terms, is basically just a curve with the various interest rate using a zero coupon bond, right? If you want the full detailed explanation, you can use ChatGPT. They explain to you in very sophisticated, proper finance term. But in simple layman terms, it's just a spot. It's just a curve with that is built using the zero coupon bonds. Okay. Now, having said that, we know that a zero coupon bond in the market have typical maturity dates. So I think the typical ones are 1 year, 2 year, 5 year, 10 year, I think it's 30 year, so around there. So 1, 2, 5, 10, 30, something like that. Some you might have some in between, right? Meaning what? That there is no full range of spot rates that we can get. So meaning what? There is no 1, 2, 3. So if I want a 3, I do not have it, right? Because there's no zero coupon bond that's 3 years. Or in the most, these are typical case, right? There's none of it. Uh, and so this is where there's some gaps in between our spot curve. So imagine our spot curve is like this, right? And then suddenly it's up, and then there's a big gap. So there's some gaps here, right? There's some gaps because it's not every year. There's a zero coupon bond that they don't issue zero coupon bonds with maturity of 1 year in advance. Everything's 1 year, so it doesn't happen that way. Okay, so your basically your zero coupon bond, these are considered your spot rates, right? These are spot because you know them based on your zero coupon bond, which is being issued in the market. So you know them for sure. Now, because if we want a 3 years, say we want a 3 year spot rate, we want a 3 year spot rate, but we don't have it. So that's where we have to do some extrapolation of information in the market using forward rates. So this is a very important part to understand this. So again, I repeat, there's a spot rate curve, which is derived from a zero coupon bond that's issued by the government, right? And they are in very uh, fixed maturity 1, 2, 5, 10, etc. Now, let's say if I want a 3 year spot rate, we do not have a 3 year zero coupon bond, which is why we have to use the forward rate to get out or determine the spot rate. Okay, does everyone understand this? Because this is one of the fundamental concept of this uh, forward rate and spot rate, which is very important for the rest of today's lecture. Uh, is it clear? Anyone needs me to repeat or you have a question on this? Okay, so let me repeat again. Okay, so the spot rate curve is based on a zero coupon bond. Okay, spot rate based on zero coupon bond. Now, your zero coupon bond that's issued by the government typically only has certain maturities. For example, 1, 2, 5, and 10. Okay, there are certain maturities. Now, in a situation where I need a spot rate of 3, right? What is the spot rate of 3? Need here, right? Spot rate of 3. I do not have a zero coupon bond of 3 years, right? So if I do not have a zero coupon bond of 3 years, I will need to now use my forward rate to determine the spot rate. Okay, and how do I do that? That's where this part comes in, right? So I create now a portfolio. So two portfolios. Portfolio one, where we have a 1 year. So we have a 1 year instrument, right? So this 1 year instrument can be a 1 year zero coupon bond. And then we have a 6 months instrument that matures in 6 months, and then you can buy another 6 months instrument. Okay, so we have the example is the next slide, so we can kind of see it here, more pictorial version. So in investment one, the investor buys a 1 year spot rate um, product or a bond. So this 1 year is like this, right? 1 year, one entire year here like that. So you straight away lock in the 1 year interest rate. Now, a second investor can say, I want to do a 6 months, and then at the 6 months mark, meaning at here, I'm going to buy another product that gives me a 6 months, meaning that this 6 months plus 6 months gives you 1 year. So because they are equivalent, so these two must equal, right? So this one must be equals to this one. Now, the question I hope you can ask is then why do I not know why is there F here, right? Why do I not know what is a Z? let's say this is Z2, or okay, here is Z2, right? So I can't use Z2. So maybe let me just say 1.2, Z1.2. Anyone can answer this? Why is there F there? Why can't I know what's Z1.2? You are right, totally. Perfect. You're right. So you understand. So the rate at 6 months might be different from today. Yeah, right. So okay, what does this mean? It means that today is I'm here right now. So today, 1st October. For 1st October, I know what is my 6 months rate. I know what is my 1 year rate. But do I know what is the 6 months rate 1 year, 6 months from now? Meaning, do I know what's this? Do I know what is the I repeat, do I know what's the 6 months rate 6 months from now? You do not, right? You do not know what is the 6 months rate 6 months from now, which is why it becomes a F. And F is your basically your forward rate. Is what is forward. Okay, I repeat again, you are at today, right? Today, you are here, right? Today is here. Today, you know what is your 1 year rate. You know what is your 6 months rate. So you know this one and you know this one, right? 1 year and 6 months. But do you know what is your rate 6 months, your 6 months rate 6 months from now? Meaning, do we know this rate here? We do not know, which is why it is called a forward rate. Oops, you can't see the F now, but yeah, it's a forward rate, right? So in this portfolio, they should be equivalent, right? Your 1 year rate, which means this part here, must be equivalent to having a 6 months investments, and after that, taking this investment and putting it in again for another 6 months, where your second half of the 6 months is your forward rate, which is unknown to you. But do not worry because you can actually calculate it, right? Because now we have created a no arbitrage scenario for two portfolios. And so what does this mean? It means that I can equate them. So I'm going to put in some numbers now. So typically all your rates that has been quoted in questions are your 1 year rates, right? Based on 1 year, meaning on annualized basis. So for your Z1, so your Z1 is your 6 months, your 6 months, so you divide by two. And your Z2 is your 1 year one, which so you need to divide by two because your rates are all in 1 year, right? Annualized. So if an investor is indifferent between the two strategy, then they must be the same, right? So on the first one, remember this one, Z2, so 100 times 1 plus Z2 square, which is this one here, right? Square because it's compounded twice, right? 6 months, 6 months, must be equals to the strategy 2, which is given by this, right? I pick my $100, I put for 6 months, and after 6 months, I take the money out and put it in again for 6 months. But while I know what is my initial 6 months rate, my subsequent 6 months rate is a forward rate, which I do not know, but I can determine it based on this no arbitrage opportunity strategy that I have equated, right? So I equate the two scenarios of 6 months, 6 months strategy, meaning strategy 2, and I equate it with our 1 year strategy immediately. And in doing so, I can determine what's F, which gives me my forward rate, F, which is 0.028. So what does this mean? It means that in order for my both strategy to be equal, my rate, my forward rate here in 6 months' time must be equals to this 0.028752. Can you see something that's very interesting that's happening here? You have now used your spot rates, right, based on your zero coupon bonds to derive, or we call it in finance term, backed out. So backed out meaning we kind of determine from the backwards the forward rate from the spot rate curve. So I repeat, we have used our bond or zero coupon bond to determine the spot rate curve, which we use the spot rate curve to determine the forward rate. Okay, this is a very important concept. So I hope you can see the flow from zero coupon, then it goes to spot rate curve, and then we have determined our forward rate. Do you have any questions for this? No? Okay. So this is what we have seen here, right? So in actual fact, if we use bond price, is actually just the price of the bond at t minus 1 divided the price of the bond at t, which is equivalent to this. And this will give us our forward rate, which is 1 plus forward rate. Okay. We have I think we have two examples here. Okay, so don't worry. We'll look at the two examples. So the future interest rate can be inferred from the spot rate. So basically, the future interest rate is your forward rate, can be inferred from your spot rate curve, right? So like what I mentioned, zero coupon gives you your spot rate curve and gives you your forward rate. Your forward rate is derived from your spot rate curve. Okay. So your forward rate is embedded in your spot rate or spot yield curve. There are information about the market. So it gives you information about the market consensus. Is a key. Uh, it's used for future and forward pricing and short contract pricing, which we are going to look at. Which this is the important part. We are going to use this spot rate curve to help us. Okay. So we have an example here. As a CFO of a Singapore multinational, you expect to receive 10 million from a foreign subsidiary in 1 year, which will be used to pay dividends 1 year afterwards. Okay, not knowing the interest rate in 1 year, so we do not know what's the interest rate in 1 year, right? But this will be used to pay dividends 1 year afterwards. What would you like to to lock into a lending rate 1 year from now for a period of 1 year? So it's 1 year from now, but for a period of 1 year, given the current interest rate environment here. Okay, so because we want a lending rate 1 year from now for a period of 1 year, it means that we want a year two, right? We're looking at year two. So this year two, 1 plus year two, or 7% square must be equals to locking in the rate at 1 year plus of 1 plus times a 1 plus forward rate, right? Which is something that you do not know that's in between these two things. So the forward rate can be, you can just shift the formulas here and there. We get the forward rate of this. So this is the forward rate which you need to lock in for 1 year from now for a period of 1 year. So this is the forward rate based on your current interest rate of at 1 year and your current interest rate of this in 2 years. Okay. Alternatively, we can look at bond pricing. So for bond pricing, recall the formula that I mentioned here. We take the bond price at t minus 1 divided by bond price at t, right? So in this example here for bond price, Yang would like to have a forward contract to borrow 20 million 3 years from now for 1 year. Okay, can you tell me can anyone tell me which is the time period are we looking at? What does it mean? 3 years from now for 1 year. Okay, year four. So we want to look at year four, right? But it's 3 years from now. So that means this one, this component here, right? Yeah, you're right. Can you quote? So the question is, can you quote the rate of the forward loan? So the forward loan basically is your P minus one, right? P T minus one, which means is at year three divided by your PT, which is year four. So your correctly pointed out is year four. So this will be our forward rate. So price at year three divided by price at year four minus one. So this is the forward rate that we can quote. Yeah. All right. Any questions on forward before we go to futures? So we will touch forward again in our last part of the lecture, but this foundation of understanding what is a forward is extremely important. Okay, I guess no questions. So this forward rate, we will again use it in the next lecture, lecture 5, right? So this is a very fundamental concept that you need to really understand so that you can do a bit more complex type of questions. Okay, so for futures, this one I think might be a bit easy. It's just telling you, futures are like forwards, basically, same thing, just that it's more standardized, it's being traded in a stock exchange, you have daily mark to market, um, and mark to market is given by this. So in lecture one, we actually went through a very comprehensive example of mark to market. So this is just a more simplified example. Uh, and how it starts is, okay, we have a price of 19, and let's say at this is in time zero. At time 30, our price has fallen. So if you take a long position on your futures, you will have now lost $4. As the price go up, you lose less, right? And at $18, you kind of you have gained $1, but then net this one minus 4 plus 2 plus 1, which you lost $1, right? So basically, this is just showing you the mark to market effect. On the short position, you take the reverse. Okay, this example, there's no workout solution. This just show you what future contracts could look like. But more importantly is let's look at this future contract example here, right? Okay, so let's look at this example. Yesterday uh, um, you bought on 10 January 2025 rough price contracts from the Chicago Exchange at a price of 15.860 per 100 weights. So the contract size is 2,100 weights. The tick size is 0.01 per 100 weights, $2 per contract. Okay, you agree to buy 20,000 weights, which means 10 contracts, right? Because each contract is 2,000, right? So you want to buy 20,000, which is 10 contracts of rough rice. So the value of this position yesterday, because they are yesterday, right? Uh, is basically given by what? So the price yesterday is this, right? Your price yesterday times you are going to buy 10 contracts of 2,100 weights, right? Because this is 15 per 100 weight. So you're buying 2,000 of this and you're going to buy 10 contracts. So this will be your notional amount here. So today, the future price closed at this 15.8, meaning that the price has dropped, right? The price has dropped per 100 weights. So you multiply it like this, and then you realize what? Oh, you know what? I have made a loss of 120. So 1.2K, you make a loss of 1.2K. So this is a simple example of a future contract. Um, in a case of a commodity, generally a commodity, yeah, you could actually be buying the actual commodity itself. So you can either buy a future contract on the commodity, meaning that you're going to eventually buy the commodity at time equals to t, or you can actually buy the commodity and store it till time t, right? So for commodity, again, I repeat, there are two ways. You can either buy a future contract, which allows you to buy the commodity at a future price, X, or you can actually buy the physical commodity and maybe store it till the time t. Okay. In both cases, again, this is a no arbitrage uh, strategy where in both situation of having a future contracts and actually buying the commodity outright should give you the same payoff, right? And so we can equate them. So let's look at what's happening here. At time zero, if you buy a future contract like a forward, you pay nothing, right? You pay nothing. But we know that the future price we will pay is H not T, right? This is the price that you have to pay for a future contract at time T. Okay, so I use H for future. So earlier you saw F for forward, for future, we use H. Now, if you want to buy an outright asset, you can actually borrow some money, right? And use this money as not to buy the asset at time equals to zero. Now, at time t, what happens? On the future side, you know that the future, you simply just pay your cost of the future, right? Which is H not T, and you own the asset after that. Right? You pay the price that you agreed upon, like your for the future. If you buy an outright asset, now what happens? Because you have borrowed S naught, right? So you need to pay back S naught with some interest to the bank. Basically, you pay back the bank for your loan that you have taken. Now, since you have bought the physical asset, imagine you have bought some iron, right? You will probably need to pay some storage cost of your iron. You have put them in a warehouse, let's just say. So you have some additional cost that you have incurred for buying the iron. Now, however, let's say you need to sell your iron because you have a physical iron with you. You have gained some convenience yield. You have gained some benefit of having the physical asset, which is a benefit to you. So this convenience yield basically reduces your costs because you can immediately sell your iron. Imagine a buyer approach you tomorrow and say, I want to buy your iron. You immediately sell your iron to him, right? There are some convenience or benefit of owning the physical asset instead of owning contracts, future contracts. Okay, so what does this equate you to? So the total cost for the future basically is very fixed. You just pay H not T at maturity to gain the commodity. Now, on the owning of the upright commodity like iron ore, we first have to pay the stock price, or not really stock price, but basically the amount you borrow, you have to pay that plus the storage cost to keep your iron in the warehouse, minus, meaning this is a benefit to you, minus any convenience yield, right? Minus is a benefit. So by equating this formula, we see that the forward, or not forward, the future, which is equal to forward, because they are kind of the same, other than the OTC, those that we talk about, but more or less they are the same concept. The future equals to the forward, which is equals to basically the stock price plus any storage and minus any convenience yield. I hope we can immediately see this. Can you see that this component here, F not T equals to stock price compounded, is exactly the same. Okay, I'm just going to flip over to show you. It's exactly the same as the pricing of your forward that we have talked about here, right? This is exactly the same. But in a situation of a commodity, we now consider some storage costs and we get some benefit of owning the physical commodity in the form of convenience yield. So the the pricing of a future contract for commodities is therefore given by this, right? S naught times 1 plus R plus C minus Y, where R is risk-free rate, C is percentage of storage cost, and Y is the percentage of convenience yield. Do you have any questions for this? Okay, following well. Thanks. So this is an example for you to have a look. Valuation of a gasoline futures. Gasoline futures quoted on October 2nd, 2024. We have a spot price of 0.776. On April, our future price was 0.733. 6 months risk-free rate is given by this. Annualized storage cost is 4.15. What is the annualized convenience yield? So we can put in the various figures and then determine what is the missing variable. And in this case, it's the convenience yield that they want you to determine, right? Because they have already given you the future price already. So future price, H naught T is given by this. So H naught T is given by this. The spot price is given by this, and then we plug in the 6 months. So these 6 months are just want to highlight to you here, this is important. Please read the question carefully when you do your assessment. This is 6 months, so you do not need to divide by two, right? This is already divided by two for you already. So it's 6 months interest rate given by this. Um, Annualized, so it's annualized, given by 4.15. So please read the question carefully. Yeah. So and what is given. And so we determine what is Y, which is the convenience yield here. Do we have any questions? So it's a simple example. Okay. So um, maybe we take a short break case. Let's take a short break first before we go to swaps. I know it's a bit early for break, but let's take a short break. Yeah, let's take a short break before we go to swaps. Okay. Maybe we come back at 8 p.m. So 8 minutes break, then we'll do swaps. Okay. Never too early. Yeah. Okay. Let's do a short break. You can go to the toilet and we'll do swaps in a bit. All right. All right. Welcome back. How's everyone doing? Great. Good. Okay. Okay, good. All right. Okay, let's do swaps now. Okay, so I think this part might be a repetition. So this part is just explaining you what is a swap. Just want to check, have you all covered swaps before? Yes. Okay. So this might be a repetition. Um, but I think the next part where you value swaps, this is the part that is probably new. But let's cover what is a swap first. Might go a bit quickly because it's a small repetition. Okay. Okay. So swaps are basically agreement to exchange a cash flow based on specific time, based on specific rules, right? So swaps are not traded on exchange. They are generally over the counter OTC, governed by the ISDA Master Agreement. So those who are in corporate banking or looking to be in the global markets department in corporate banking, we will see a lot of this ISDA agreement. But even for myself, we negotiate ISDA agreements for the clients as well. So this ISDA agreement is a very thick set of document, easily 100 over pages, governing the swaps. Generally, things like your threshold, amount, um, yeah, basically some protection because these are over-the-counter products. So you need some kind of agreement between the two parties. And the ISDA agreement is kind of a standardized agreement, but allowed for some customization. Okay, so a swap is made up of a series of forward contracts. It means that there is no cash upfront payment. All right. Um, for a currency swap, the notional will be exchanged. So if you're looking at cross-currency swap, meaning you're swapping, for example, euro to pounds, which we'll look at in a bit, there's going to be some exchange of principal. But in most other cases, it's just a netting of the proceeds, right? So we'll look at four type of swaps: interest rate swaps, floating to fixed, fixed to floating, floating to fixed, or fixed to floating. Um, Currency, so currency, we'll look at different kind of currencies. Equity swaps, we are swapping either an index to exposure to a certain basket of stocks. And last but not least, the commodity swaps, where we're going to swap some energy products, right? But our main concern is actually the first three. The fourth one is just a small component that we'll just discuss quickly. Right? So this, I think, is a very important part on swaps. Okay, where does the interest rate swaps comes in? So this is very important because this is where many are a bit confused. When do you use a swap, interest rate swap, and when do you use an interest rate option? So there's two things, interest rate swap and interest rate options. Okay, so in a situation where the interest rate is changing from the time the loan is anticipated till the time you take up the loan. Okay, so for example, you say, I want to take a loan in December. Now, in the process from now to December, if there's going to be fluctuation in the interest rates, this is where you need to use the interest rate options, right? Option, as you know, option can be a put option, call option, and this option will allow you to mitigate these fluctuating interest rates. Now, interest rate swap comes in when the loan has already been taken up, and now you want to convert the type of interest rate from either a floating to fixed or fixed to floating. So this is where interest rate swap come in. So there are two kinds, interest rate option and interest rate swap. So interest rate swap are generally taken up when you have already taken up a loan and you want to do the swaps of the rates. So it's used to manage the interest rate risk. Okay, so this is a simple example here. So Microsoft and Intel. Anyone following the Intel story, Intel stock story, or in the markets? No, Nvidia. Yes, okay, some of you, yes. As so for those who don't know, Intel stocks have been on the rise quite recently because of, first of all, the government stake in Intel. Basically, they want to grow some domestic foundry business. So Intel is one of the top targets. So the government has taken some stake in it. If not wrong, also think is it Nvidia and even Apple has some contracts or signed some agreements with Intel, so stocks have been rising. However, I think year to date, for the entire year of 2025, Intel stocks has been very low. Um, yeah, so I actually have some Intel stocks from a while back, and finally when the stock price rise to a good level, I quickly sold it off because it has been a loss making on my portfolio for the longest time, right? So in case you are interested by Intel, it might be a good time to buy. Yeah, it was a long wait. So I actually bought it, I think, 2 years ago when it was dropping, and I thought it will rise, but it has been falling for many, many years. Not many, yeah, many years it has been falling. So I decided to get out of the trade by quickly selling it when the stock price rise, at least not for a loss. So just made a small little profit. Yeah, that's Intel. Microsoft, on the other hand, is a separate story, right? Microsoft has been doing super well on this stock market. Yeah, that's right. So the question is, what if you go higher? But I think for those who are do some side trading, you know that when you do this kind of trading, you have a number in mind. For example, you say once it hit let's say 10% return, I will sell, right? So you need to have a very fixed kind of like and very fixed and disciplined mindset to know that if it hits the number that you have committed to, you must sell regardless of what the market tells you, right? So you avoid any bias that you have, emotional attachment, etc., right? All your emotions coming into play. So yeah, you never know what will happen. So yeah. So anyway, that's a sidetrack. So on Intel and Microsoft. So we are looking at Microsoft now in terms of an interest rate swap. So in Microsoft borrowed X and agrees to pay out LIBOR, right? So you are paying a floating. So it enters a interest rate swap with Intel. And with Intel, it's going to pay a fixed 5%, right? 5% to Intel. Um, and in return of paying 5%, it receives LIBOR, where LIBOR is being passed on from Intel to Microsoft and Microsoft to the end um, user here, put a question mark here, right? So what this means is that net, Microsoft is going to pay 0.1% plus 5%, right? These two, it adds up together. And this is the net fixed interest rate that it has to pay now instead of paying the floating LIBOR plus 1%. So we have now transformed LIBOR plus 1% into 5.1% fixed. So this is a floating to fixed. On the other side, Intel, um, in order to pay Microsoft LIBOR, right? In order to pay LIBOR, Intel would have went into the market to get to pay 5.2% with Y here, let's say Y, 5.2%. Okay, and because it received 5% from Microsoft, so the net effect is what? This one minus 5% plus LIBOR, right? So the net amount that Intel is going to pay is now floating, which is LIBOR plus 0.2%, where 0.2% is 5.2 minus 5%. So he has converted its fixed into a floating LIBOR. Oh, sorry. Uh, yeah, so you've converted a fixed to a floating LIBOR. Of course, those of you who are already in the market, you know that LIBOR is no longer there. This is just a whole example, right? So now we use SORA. Okay. This is a more numerical example here. So we have a plain vanilla interest rate swap. The agreement by Microsoft is to receive 6 months LIBOR and pay a fixed 5% per annum every 6 months for 3 years with a notional principal of 100 million. The fixed amount that you pay, so fixed, we know that it's 5%, right? Because it's 5% per annum every 6 months, right? Based on the notional of 100 million. So this is the fixed amount you have to pay for each period. Suppose the 6 months LIBOR is 4.2. So this is a known one. The current 6 months LIBOR is 4.2. Your floating would be 4.2 times 0.5, which is 6 months, right? Times 100 million. So this is the amount that you have to pay, 2.1. So the net cash flow basically is your 2.5 minus your 2.1. This is just a simple example on interest rate swap. Example here, your currency swap. So a currency swap, recall what we mentioned, that currency swap has a physical transfer of your notional currency or your in order for you to, of course, use the money. Because for example, in this case, you need euros, so you need the physical euros, right? You do not just net off the amount at the end of the swap period. Okay. So for this example, we have this company called Rotec, which is a British high-tech company currently planning to expand in in the European region, where it needs where the expansion will cost 30 million pounds, right? For this expansion. The current interest rate is this, which means that expansion in Europe will cost you 48.6 million euros here. Now, Rotec could issue a euro-denominated bond, but it's not that well known in the euro market. So it could actually issue a pound-denominated bond and convert this into euro using a cross currency swap or currency swap. So this is very common in the corporate industry, right? So I think there are a couple of y'all who is in corporate banking, you know that this is quite common when you issue, let's say, a US dollar related bond, and then we convert it to, or not really US. No, normally you use JPY bond, and then we convert it into US dollar because your JPY has very low interest rate. Okay. So in this sense, we issue the bond in pound, which is 30 million here. So Rotec gets 30 million of pound, and then it enters into a swap with SV, swap bank, right? Swap bank. It enters into a swap with a swap bank to give the 30 million pound and receive the 4.8, 48.6 million euro. So what happens now? Okay, so the transaction begins at 1st of June. Okay, Rotec borrows, get the 30 million pound and receive the proceeds from the bondholder. The bondholder carries a interest rate of 5%, right? Because of course you have to pay interest to your bondholder as well, 5%, which requires annual interest payment on 1st June. Rotec enters a currency swap with Sterling Bank or the swap bank. It pays this 30 million and receive this. And of course, this swap will also have interest, right? So in this sense, the term of a swap, Rotec has to pay the Sterling Bank 3.25% euro for the interest, and then it receives interest of 4.5% in pound. So the net effect here, just to highlight, is that it has to pay the interest payment as well, which is a net of 150k pound given by here, right? So this one here. So the bondholders require 1.5 million pound, and then what you're getting from the sterling bank is 1.35 million pound. So there's a net payment of this which is required. So 3 years later, we will need to unwind our swap and return the bondholders the 30 million pound. So then we do the reverse of everything, right? So we return the swap principal, which is 48.6 million euro. The bank gave us back the 3 million pound, 30 million pound, and the 30 million pound return it to the bondholders. And the swap is now terminated. Okay, and your bond is also terminated. So this is what was happening in the last slide, right? Now, suppose that we rotate wants to now convert the interest rate from floating to fixed, right? So now it wants to thinks that it thinks that euro interest rate is going to go down. It wants to take a certain view when it enters this uh, swap. So it promised to pay the counterpart in euro floating and receive interest rate on the fixed. So basically, it wants to fix its interest rate, right? So it's afraid that interest is going down, so it wants to fix the interest rate, so it can enter another swap with a different bank to pay the floating and receive the fixed, right? So that it can use this fixed to pay off your bondholders, which is required to pay at a fixed 5%. So for equity swap, we are exchanging one set of payment, typically stock with an index, right? So there's just some comments, there's specific tenor. One leg is called equity leg, which is typically pegged to a total return. For example, pegged to S&P 500. The other leg can be a stock. It can be pegged to a floating interest rate kind of situation. So let's look at this example here, right? Uh, let's see how this equity swap works. So generally, the amount that's being paid will be determined by the supply and demand of the underlying index. So the supply is who is seeking to pay the equity return. The demand is what is the index that the party wants to receive, right? So pricing based on supply and demand. So in this case, the user, let's say Mandy, wants to hedge her total return of a portfolio, right? So Mandy has been receiving S&P return here. We want to now hedge this S&P return by entering a equity swap to give this S&P return to a equity swap dealer, which will then pass her 9.95% per annum to Mandy and payable per quarter. And this swap is for 3 years. So actually, this swap, depending on what you feel about the S&P return, of course, for those who have invested in S&P this year, you know that this year has been quite a big bull run, and you will easily earn more than 9.95%. So maybe this swap is also good. So for those who have invested in S&P in April this year, where the market was the lowest for the year, I think you have easily gained 20% by today, right? So for those who take advantage of the April low, um, you have easily earned 20% simply by investing in S&P. Okay, so in this sense, maybe this 9.5 not so good. Maybe Mandy should have just kept the S&P return if the market really gave her 20%. All right. So an alternative for Mandy to hedge her equity portfolio is also available. It's inexpensive and supply will be low. So for example, in normal times, a swap dealer may offer S&P return in exchange for LIBOR plus 200, but when the supply is low, then the S&P will be exchanged for more, right? So it really depends on supply and demand, which is how they price the swaps for this, how much the dealer will give Mandy in this case. So on demand side, transaction cost might be higher to buy the S&P 500 and enter a swap than for swap dealers to offer less on the receiving leg. Okay. So basically what all this saying is just example of how supply and demand can affect how much being paid to the end user, right? So, for example, in this case, remember you are Mandy here, supply one, you receive the S&P, so you enter a swap with a swap dealer, which you will give the person the S&P return and give you 2% LIBOR, right? However, in the case where maybe the demand is higher, then this swap dealer can enter another swap into the end user to give the S&P return and receive even higher LIBOR, so LIBOR plus 3%. So this is in the situation where this leg of the swap, there is a higher demand for the S&P. Last but not least, we look at commodity swaps. We won't really talk so much about this, but basically a commodity swap is where generally it happens between oil company and refinery. So what happens is this, right? So the oil company would generally prefers to receive a fixed price on the oil, and the refinery prefers to pay fixed, right? So the refinery prefers to pay the fixed, so refinery refines the oil, so it will pay the fixed to the bank, which will then pay this fixed to the oil company, and the oil company will pass the variable price of the oil to the refinery. This one we'll just cover very lightly because I think in the last lecture we're going to cover in more detail. So a credit default swap basically is an insurance policy. So it's an insurance policy where as a buyer of this protection, you pay, so you are the buyer, you want to buy this credit default swap, you pay a fee to the protection seller. It can be a bank, right? So a bank might sell this. So the bank would then give you this agreement where if a default happens, they will cover the default risk. So this is just like a insurance policy for any default. So you can buy a credit default swap on basically any kind of products, any kind of underlying. Okay. Before we go to swap valuation, any questions on this swap? So I know it's a repeat, so I'm kind of just going a bit faster on this. Any questions? No, all clear? Yeah. So I understand from teaching previously, so this is kind of a repeat, so we cannot dive too much detail. All right, all is good. Okay, then let's look at this. So this is a new part, right? Swap valuation, which is what is quite important on today's lecture. Okay, so let's look at swap valuation. So swap valuation, the swap market is calculated based on the present value of the amount of risk or credit loss. Um, so interest rate and equity swaps, generally, we have the highest credit risk for in the middle of the swap life, right? The reason why is at the beginning, we have done a lot of the assessment, we have performed sufficient credit risk analysis, so we are pretty protected at the start. At the end, the credit risk kind of diminishes because there's less amount of payment, right? Imagine your interest rate swaps. At the end, there's only a few more interest rate swaps left, so there's not much payment left, so the payment risk is very low. Now, in the middle is where the counterparty conditions can change dramatically, meaning that it can suddenly become bankrupt. And so, in the middle of the life of swap, that's where your highest credit risk is at. Now, in a currency swap, because you are swapping the um, notional amount, the greatest risk happen in the middle and the end of the swap because you actually swap the principal at the beginning and the end of the swap. But of course, at the beginning, you have done necessary credit risk assessment or analysis to ensure that the risk is mitigated at the beginning. So the greatest risk will be at the middle and end. Okay, so at the initiation of interest rate swap, the counterparty agree on the following, right? So we're looking at interest rate swap. So what are we swapping? We are swapping the uh, fixed payment with the floating rate payment, right? And of course, at the initiation means the present value, right? The present value of the fixed payment must equals to the present value of the future floating rate payment, right? In a situation of a swap of fixed to floating. So the fixed rate payment is called the swap rate. We typically call it the swap rate. And the swap rate actually determines the price of a swap, interest rate swap. Okay? So in this component of today's lecture, we're trying to price the swap. Okay, so I repeat this again. For a fixed to floating or floating to fixed rate swap, the present value of the fixed rate must equals to the present value of the floating rate, right? Immediately from here, which variable do we know and which do we not know? Yes, you're right. The fixed is known, correct? The fixed is known, the future floating is unknown, right? So this is a question mark here. Floating is unknown, fixed is okay. We know the fixed because this is fixed already. That's right. So based on this concept of which is known, which is unknown, this is how we're going to determine the price of the swap. So we are going to determine the fixed interest rate, which will then give us the price of the interest rate swap. So again, I repeat, we want to determine the fixed interest rate, and by knowing the fixed interest rate, we can determine the price of a interest rate swap, since the floating is unknown. Okay, this slide has a lot of details, and it will make sense in a bit, but let me try to explain to you what's happening here. Okay, when we look at examples, which then will become very clear when you review this slide again, but this slide is important. Okay, let's dissect what's this trying to say step by step. Okay, the payment of a fixed rate payer is known, right? The person paying the fixed rate, because fixed rate is based on the fixed present value of fixed rate, which is known. The floating rate payment is unknown. And why is the floating rate unknown? It's because it's based on the reference spot rate, say the future LIBOR at the reset date. What does this mean? It means that the floating rate amount is based on the forward rate. Remember, we are going back to forward again. Your forward is derived from your reference spot rate curve, where the floating rate is being derived from, right? So there's a small comment, floating rate Now we use SOFA instead of LIBOR. It's just a small comment. So in any case, the floating rate payment is given by this, right? What is your notional? Because remember earlier we saw an example on how we calculate the notional times the LIBOR times the period. So the floating rate payment basically is based on the LIBOR, right? And this LIBOR is something we do not know. It is based on the forward rate, which is mentioned here, right? So, however, we can use the forward rate of forward future contracts to lock in the forward or future rate, which is your 3 months LIBOR. So we use the forward contracts to lock in this LIBOR amount. So by using the forward rate, which we determine using the spot rate curve, we can then calculate the present value of the floating rate payments. And how do we determine present value? We need to use the forward rate to discount the payments to present value. So this forward rate will be used as a discount factor to discount them to present value. And this discount factor is called the forward discount factor. Okay, so this last part, don't worry, we'll cover this in a bit. So let's put that aside. Okay, so I repeat again. So what's happening here? Okay, so we want to value a swap. Okay, so now let's think of it in layman terms, right? And a big picture. So we want to value a swap. We know that the present value of a fixed rate swap is equals fixed rate, present value of fixed rate equals to present value of floating rate. Now, the floating rate is unknown because the floating rate changes. So in order to determine the price of a swap, we need to determine the fixed rate. Okay, so we have determined that. Now, in terms of the rate being used, we know that a floating rate uses, for example, LIBOR, right? And this LIBOR can be determined using the spot rate curve by getting the future forward rate through the spot rate curve or backing out the forward rate using the spot rate curve to determine what is the 3 months rate from now, which is the 3 months LIBOR. Okay, so if we have the spot rate curve, we can determine the forward rate, and with the forward rate, we can determine the floating rate payment. With the floating rate payment, we can determine the fixed rate, present value of the fixed rate, which then we can determine the swap rate, right? We call us a swap rate. Swap rate is this, swap rate, which will give us our price of an interest rate swap. I repeat again, if we have our spot rate, we can use the spot rate curve to determine the forward rate, and this forward rate can be used to find out what is the floating rate payments we are getting. Once we know what the floating rate payments, we can then calculate what is our present value of floating rate, which is equal to the present value of the fixed rate. And if we know the present value of fixed rate, this is our swap rate, and our swap rate will give us our interest rate swap, price of an interest rate swap. Okay, so let's put this in an example. So whatever I mentioned earlier, this example hopefully will show you the details of what's happening here. Okay, so let's dissect this example here. Suppose we have a 2 years interest rate swap. Oh, sorry, 2 years interest rate swap with a notional of 100. Suppose the fixed rate leg has 4 semi-annual payments. The floating rate consists of 4 semi-annual payments at LIBOR, L1, L2, L3, L4, with the respective forward 6 months LIBOR rate given here. So this is a 6 months forward LIBOR. So you are looking at forward rate here. The forward rate is obtained from Bloomberg. So this question is very good because they will give you the forward rate, which is actually determined from the spot rate curve. So just to let you know, question can give you the spot rate. And if question gives you a spot rate, do you know how to calculate the forward rate? So you need to calculate the forward rate using the formula given earlier, right? So I'm just going to quickly jump back to the formula just to quickly show you. You need to use which one? This one, right? This one. So if question gives you spot rate, you have to use this formula to determine the forward rate. Okay. But in this question, they're quite nice to use, so they give you forward rate, right? So with the forward rate, remember the steps. With the forward rate, I can determine the floating rate payments, right? Okay, let's do it step by step. So we have, this is the question, right? The question has given us the forward rate based on the 6 months LIBOR here. Okay, so as you know, forward rates or rates in general are quoted on annualized basis. And so since we are looking at 6 months, we need to divide by 2 here. Okay, so this is not too much an issue. We divide by 2, all the rates divide by 2. Now, remember our objective is to determine the present value of your floating rate payments. Why? Because by determining your present value of floating rate payments, we can equate this to the present value of the fixed rate payments, which will then give us the fixed rate, which is equals to the swap rate, which is equals to the price of a swap. Okay, I hope you can see the connection. Okay, okay. So now with the semi-annual forward rate, we can now determine the floating rate payments for each period. So we determine the floating rate payments accordingly. These are the floating rate payments. Now, we need to determine the present value of floating rate payments. And the present value, we're going to present value it using the forward rates, right? And in more specifically, the semi-annual forward rates, which is given here, right? The forward rates here. So this is the discount rate given. So we have determined just the discount rate, and we use the discount rate multiplied by the payment. So just going to highlight here, this one multiplied by the discount rate, this one multiplied by discount rate, right? So you just multiply to the discount rate. So then we'll get the present value of the floating rate payments. But we know that a swap is built by a series of forwards, right? So is this basically a series, meaning a summation of these, right? So what's the sum of the present value of floating rate payments? You just add up all your floating rate payments. And in terms of your discount rate, this is your sum of your discount rate or discount factor. Now, the question is why are you doing this? Remember the step. So I'm just going to pull out this again to just illustrate with a bit more detail. Sorry. Okay, so let's just illustrate with a bit more detail. So recall the steps. So we have the spot rate. Spot rate will give us the forward rate. The forward rate will then give us the floating rate payment, right? We can use the floating rate payment. This floating rate payment, we will, what we do, we sum it, right? Sum the floating rate payment. So I will say sum payments. And you're right. And we will plus the discount rate. We determine the discount rate so that all this will be give you the present value, right? Present value of your floating rate. Once you determine your present value, so we know that present value of floating rate, present value of floating link equals to your present value of your fixed link, right? Link, not rate, link. And once we determine the present value, sorry, this is going to, then we can determine the fixed rate, which will give you your swap rate. Where this swap rate is then your price of swap. Okay, so this is the whole flow chart. Actually, maybe I should write smaller. But this is the whole flow chart, right? So where are we now? So we have determined our summation of your discount rate, summation of floating rate payments, right? Now, having determined that, we know that the present value of the fixed rate payment equals to present value of the floating rate payment, which is we see here, right? This one here. Let me just use different color. This one here, right? So this one here. This one, right? Present value equals this. So by doing the equation, we can determine what is our annual fixed rate payment for the fixed link. Okay, because we plug in this value, right? This one we know. This one is the 3.796, which is here, right? 3.796. I'll just use different color here. And we know the total is 8.291,302, which is here. 8,291,302. So we just shift the numbers here and there. We calculate that, hey, you know what? The annual fixed rate payment for the fixed link is this 4.37. Okay, so this is our swap rate, right? And this is the price of a swap. Now, we want to go one more step to check whether this fixed rate link will give us the same present value of the floating rate, sum of floating rate payments. So we use this fixed rate of 4.37, we divide by 2 times the notional of 100. And we know it's fixed, right? So for the 4th period, it's going to be like this. We use the discount factor that we have calculated here. So I'm just going to show you the discount factor. Where's the discount factor? This is the discount factor, right? 0.9804, 0.9600. So these are the discount factor. So we use the same discount factor. And then we discount the fixed rate payment and we determine that the sum of the fixed rate payment at the end of the period is this, right? 8,291,302. And can you see immediately that, hey, you know what? It's exactly the same as your floating rate payment. So you know that what you have calculated. So this final step here is a proof to you that what you have calculated based on your swap rate of 4.37 is correct. So it's almost like a check for you. If you know that, if you determine that the sum of the fixed rate payment is the same as the sum of present value of the floating rate payment, then they become equal. Then you know that your calculations are correct. Yeah, it's a bit like a magic, right? It's like, hey, how come it's like this? But if you understand the concept, it's like, oh, okay, it makes sense. They should be equal. So in any case, if you do your assessment and you realize that when you do this final check here, usually this is not required. You look, read the question carefully. Usually this is not required. Or if they do ask you, uh, then you should be able to equate both of these. The present value of fixed rate to present value of floating rate. If you can't, that means something's wrong. There is. I guess sometimes yeah, there is. And normally please use Excel to do this. Don't use manual calculation because you are working with a lot of decimal points. If you do any rounding in the intermediate steps, you're going to have a lot of issues trying to match and determine the present value of the fixed rate equals to the present value of the floating rate payments. So this is method one. If you see this method one, there's a second method which I'm going to teach you, which gives you the same answer. Okay. Just want to highlight to you one thing. This method that I've taught you, right, so far, so these two slides, method one, is treating everything in terms of using compound interest. So if you go to look at the lecture group slides, lecture groups mean the main lecture groups are the L01 slides, you'll see that the method looks very different and you might be very concerned, but please do not be concerned. So the lecture note slides are using simple interest. So actually we have discussed this with the course coordinator as well. So his preference is for him, because he's teaching the two tutorial groups. His preference is for him is to teach the simple interest method. Okay, so it's a simple interest method. But for me, I prefer teaching the compound interest method, because the compound interest method is the method that in the industry you'll use it. Right? The simplest interest method is simpler, but as you know, you're finance students, we never ever use simple interest, right? Everything is compound interest. Simple interest is for primary school, right? In the sense like we know no one considers simple interest in finance, which is why my preference is to teach the correct method, which is the compound interest method that I'm teaching. So in case you look at the L1 slides, you'll notice that the methods are different. Do not worry, right? For that one, we're using the simple interest method. And there might be slight deviations in terms of the swap rates that you calculate, but in the assessment, both methods will be accepted. So in the report, I suggest to use the compound interest method, which I taught in class. So you do not need to go to your lecture group slides to try to understand the simple interest method. Okay, you can use the compound interest method. But if your preference is to use simple interest, go ahead, you'll not be penalized. Both methods, you'll get full marks. Okay. But just be careful, because in case you go into the industry and you are in swap pricing, swap valuation, do know that you need to use the compound interest method, because as you probably see in your TMA, where there's a question on simple and compound interest, how do they deviate? You know that if the swap is 2 years, maybe the difference is going to be very minimal. But if you have a 10-year swap, which is very common in the industry, where we have 10-year swap, 20-year swap, even 30-year swap, depending on what we're swapping generally for a 30-year bond, we might have 30-year swap to help to swap the interest rate accordingly. Then your compound interest will have a drastic difference from your simple interest, which is why the compound interest is the right method. Maybe for this example here, where you're looking at 4 6 months period, your effect on compound and simple interest is going to be very minimal. All right, so is the valuation of swap at time equals to 0, meaning that at the inception of the swap, right? So this valuation is on the inception of your swap. So that means you created a swap. Now, the question is, what happens after time equals to 0? Remember this, your swap is based on present value of fixed rate equals present value of floating rate, right? And the floating rate is going to change. You know your floating rate will not stay the same. So once you have issued the swap today, tomorrow your swap value is going to change immediately because tomorrow the floating rate is going to change. So in actual fact, in the industry, we are constantly calculating the swap value every single day or every single hour, right? It really changes non-stop, which is why what we are going to try to value the swap after t more than 0, mean after inception, what happens to the value of the swap? Okay, so what's happening here? So let's try to understand a little, right? Once the swap transaction is completed, the market interest rates will change, which will change the floating rate side of the swap. And when one side changes, the other side will have to change as well, right? Because your present value of the fixed must equal present value of the floating. So the value of the swap will then be a difference between the present value of the payments on the two sides of the swap, two sides meaning the floating and the fixed. There's going to be some changes and they keep on changing. And these changes generally would be recorded in the intraday kind of fluctuations, right? So for example, if the since the fixed rate is since the rate is fixed at 4.37, which is what we calculated earlier, the increase in LIBOR would very decrease the value of a fixed rate, right? Any increase in LIBOR is going to decrease the value of fixed rate, while the decrease in LIBOR will increase the value of the fixed rate. What's important to take note is that the changes in your market interest rate will only affect one side of your swap, where it will only affect your floating rate component because your fixed rate is going to be fixed, right? Your fixed rate is fixed already. It's not going to change. But your floating rate will then affect your fixed rate payments. So let's see what this means. We have a numerical example where we continue the example we looked at earlier. So suppose, because this is very important, you really need to understand how you value a swap after t0. So if you do have any questions, do stop me. Okay. So let's look at this. So value of a swap t more than 0. So when the interest rate rise, the fixed rate payer will benefit. So let's see how does it work. So continue from previous example for if forward 6 months LIBOR rate for period 2, 3, and 4 increases as follow. So this is the previous one. This is the previous one. You flip back to the previous slide, you'll see this is the previous forward rate based on LIBOR, right? Now, after you have issued the swap, then the current rate has now changed to this. Your current has changed to 5%, 5.25%, and 5.5%. Okay, so now let's do the same pricing that we have done. So this is the new annual LIBOR forward. The same method, we are going to semi-annualize it because we are looking at 6 months period. So read the question carefully. Read whether it's a 6 months, is it 1 year. So be very careful with the question. They can kind of trick you in that sense. So this is the 6 months, so you need to divide by 2. We determine the floating rate payments, right? We are doing the same method. We determine the floating rate payments based on your 6 months forward LIBOR. So we determine based on this. Now we determine the forward discount factor or discount rate. Same, exactly the same. We're not changing anything. So we determine the discount factor, and then we multiply the floating rate, floating late payment with the discount factor to get the present value of floating rate payment, right? So we multiply this times this, give you this times this, give you this. We do exactly the same process. We sum the discount factor and we sum the present value of floating rate as given here and here, right? We sum it up. So now we have determined the present value of floating rate payment. So we know that when there's a change in the interest rate, your floating rate payment will be affected. And we know that the fixed is not going to be affected, right? That's the very important concept. I repeat again, when there's a change in interest rate, your floating rate side is going to be affected, but your fixed is not going to be affected. Okay, so we have determined the floating. Now, okay, so I also highlighted here, the fixed rate payment remains unchanged. But okay, this is important. Let's put two star here. But the discount factor is going to change, right? Your discount factor is based on your forward rate, and your forward rate has changed. Can I repeat again? Your fixed rate payment is going to be unchanged, but your discount factor based on your forward rate is changing because your forward rate will have changed after the first day of the inception of a swap. Because forward rate will keep changing, right? So you will have new discount factors. So in terms of the fixed rate payments, this is exactly the same. 2184.026, 2184.026. So I'm just going to show you, prove to you it's exactly the same. So I'm just going to click back here. Can you see this exactly the same? 2184.026. Exactly the same. So our fixed rate payments are not changing. They're going to be exactly the same. Okay, so exactly the same. Here, I've shown that it's exactly the same. Now, however, our discount factor is changing. Can you see this discount factor? It is the discount factor as I have determined here using our new forward rates. Does everyone understand this? Yes. Okay, I hope it's very clear. Your fixed rate is fixed, as what we mentioned, but our discount factor has changed. So now, based on this new discount factor, our present value of the fixed payment was going to change. This is the present value of fixed payment, which now gives you 6,227,698. Can you see that this present value of fixed rate payment is no longer equal to the present value of the floating rate? Can you see there's a variance already? Can you see a variance? One is 7 million, one is 6 million. So the floating rate payee must now pay the difference of this 7 minus 6 million if he wants to terminate the contract. So in other words, right, the floating rate payer is paying more money, right? It's losing money. He has to pay more by 1 million. He has to pay almost 1 million more to the fixed rate pay. Since the fixed rate payer only pays this, which is fixed based on the past rate that we calculated of 4.37. So floating rate payer is now going to pay 7 million, 7.4 million, while the fixed rate payer is going to just pay 6.2 million. And so there's going to be a loss incurred by the floating rate payer. Okay. So this is not the end. So now we have calculated the fixed rate, present value of fixed rate. Sorry, we have calculated the present value of floating rate. Since we have determined the present value of the floating rate, which is 7.4 million, we can actually determine what is the fixed rate or the swap rate, right? The swap rate, which is the fixed rate. And because this will give us the price of the swap. So we can immediately see that the price of the swap has now increased to 5.25%. So as a floating rate payer, you're now paying more since you only previously paid 4.37, but now you have to pay 5.25 to the fixed rate payer. So as a fixed rate payer, you can't benefit. As a floating rate payer, you have loss. Any questions? Okay, I hope everyone is following as well. This gets a bit complex. No? Okay, we are good. Okay, maybe if you have questions, don't worry. Let's take another break. As we like to do two breaks. So let's take another break, and we'll come back in around another seven to 8 minutes. And we'll do method two. So we have come up with method one of valuing a swap. Now we'll do method two. Okay, let's come back in in maybe 9:10. Okay. Hello, welcome back. So let's continue on the last part of today's lecture on method two of swap valuation. I do see a question here. What happens? What happened to period one? Ah, period one has passed. So this is the value of a swap after period one. So period one has passed. Is from 2 to 4. So imagine that after the first 6 months, then we want to value the swap again, and the first 6 months have passed already. So only left period 2, 3, and 4. Okay. Okay. Thanks for the question. Uh, okay, so let's look at method two. So method two, right, uses a different concept. It uses the idea of bonds to determine the swap price. Okay, so it's a different concept, but let's try to understand this concept here. Okay, so depending on the question, right, certain question, okay, so the thing is both method should give the same answer. So if you use method one and method two, and they give different answers, means something is wrong with your calculation. So both method one and two must give the same answer, and we can see this in a bit. Okay, we'll use the same example as what we done method one, and we'll show you that they give the same exact same answer. So method two, right? Instead of calculating the remember method one uses the present value of floating rate payment equals present value of floating rate fixed rate payment, right? Now for method two, we are using the concept of bonds to price the swap. So let's see what it's trying to say here. Okay, so the swap is priced consistent based on the term structure of LIBOR, LIBOR-based liabilities. What does this mean? This, in simple layman term, it means that it's based on the spot rate curve, which is then based on bond pricing, right? This is a simple terms. The LIBOR-based liabilities is basically bonds, right? In simple terms. So for a floating rate payer, the uh, cash flow on the swap are initially equivalent to a long position on a fixed bond priced at par, which is and equals to the short position of a floating rate bond. So because you are the floating rate payer, right? So you are paying the floating rate. So you are not you have a short position on the floating rate bond, and you have a long position on the fixed rate bond because you are receiving the fixed rate. Right? This makes sense, correct? So if you are a floating rate payer, you have a short position on the floating rate bond because it's a LIBOR-based liability, which is a bond, i.e., and you have a long position on the fixed rate bond. So for fixed rate payer, this the opposite is true. Okay, so the current market price for swap is the difference between the present value of the fixed rate and the floating rate payment. This will give you the value of the swap. Because remember, if you are a floating rate payer, you have a long position on one thing and a short position on the other, right? So the net, what is the value of this swap to you is the long position minus the short position. Of course, you need to present value it because you're looking at the value of the swap today. Okay, so there is this fact that is universally, it is a fact. So it is a truth that you need to know that a floating rate bond is always priced at par at the reset date. So a floating rate bond will have various reset date at each point of time. And the value of it is always priced at par. Hmm, this is interesting. I thought I edited this slides a little in terms of format. Just give me one moment. I did that was reflected here. There's just a bit of formatting. So this one, I actually made the brackets bigger. It's just a small little edit, but I thought I did the edit. Maybe it didn't reflect in the update the slides. We just confirm that this is being done. Okay, strangely, maybe it didn't save, so it's not being reflected, but it's okay. It's some very minor thing. Okay, so anyway, what am I saying? Okay, I'm saying that it's a fact that the floating rate bond is always priced at par at the reset date. So what does this mean? It means that at reset date, right, where the value of your floating rate is actually just the par value of your floating rate bond. So there's a proof to show you this. Okay, so let's try to work this out. So we want to find the value or the price of a floating rate bond at time equals to zero, which is now, right? What's the price now? So we do it by step going backwards, right? So we start with t time n minus one. So n is the maturity, right? So one period before the maturity, okay, we know that at maturity of a bond, we are going to get the principal payment, right? The par value F. We are going to get F at maturity. So I hope everyone knows what's how the bond works, right? At maturity, you get back your lump sum, which is your par F, principal. But because it's one period from maturity, you're going to get an interest, right, for that one period. And then at maturity, you get that principal and the interest. Where the interest is given by the par value F times the interest rate of R, right? Or small r in this case. Okay, so what do we do? Then this is equals to F times, so this is just a big bracket, it's just a bit of formatting. So basically what we're getting is F plus F Rn minus 1, right? So this can be written as you take the F out, so F times 1 plus Rn minus 1. So this is the value at n minus 1. And we know that we need to discount this back to present value, right? And the discount factor is what? The discount factor is simply 1 plus Rn minus 1, right? Because we are discounting it back by one period because we are at the time n minus 1. So we're going to discount it back by 1. And in this sense, because we're going to discount it by 1 plus Rn minus 1, these two cancel out, and it simply gets you F. Does everyone understand this? How we get the F here? Okay. Any questions, any doubts on why is it F? Okay, I guess we are good. Okay, so if we are good, no questions, okay, we get F. So then we're going to take one step back. So now we are at a situation of n minus 2. So in the n minus 2 situation, we are going to have a interest rate, right? The interest rate of par times the interest rate R times n minus 2, right? We're going to have par value times the interest rate plus whatever value that's given by this, right? Pn minus 1, whatever value that's given by this. And then, of course, we're going to discount it by 1 plus Rn minus 2. We're going to discount it by the whole factor again. Similar to this one here, right? We're just going to discount it again. Now, what's interesting is that Pn minus 1 is equals to par. So this one, we're going to change it to F. F is par. And then we see here, we can actually take out the F from this component here, and this gives you F times 1 plus Rn minus 2. And then what's very interesting now is that we can actually cancel off this one. And again, we get F par. So if we continue this way, the price of the floating rate bond at all reset dates equals to F, which is par, or the face value at time when time equals to 0, which is the current time now. Because if you keep doing it, it's just going to be F, 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 F. Everything is F. So the price at time equals 0 equals to F for a floating rate bond, which is now how we can have already proven this fact that the floating rate bond is always priced at par at reset date. So when the short is first initiated, the present value of the floating rate and fixed rate is always equal. We already know this, right? The present value of floating rate equals to present value of fixed rate payment. So present value of the floating rate payment equals to the face value of the floating rate bond, which is equals to what? Par F. And therefore, the present value of the fixed rate payment equals to the face value of the fixed rate bond. So we know that the floating rate is par, right? This one is a F, which is par. It means that we can find the fixed rate on the swap by equating the present value of the fixed rate payment. So we're equating this one, present value of the fixed rate, I use a different color, present value of fixed rate payment equals to F, which is par. Because we know that the present value of the fixed rate and floating rate must equal. So we have now just equated the present value of the fixed rate payment equals to par F, which is given here. So in the next slide, we put this in equation. So F is par, right? So we have equated par to the present value of the fixed rate payment. And your fixed rate payment is what? Is your value of your payment, right? Which is coupon times the par value, right? C times F, discounted. But what's important here? This is very important. You are discounting it at the spot rate. So I'm just going to put 3 stars here. This is very important. So for method 2, this formula here, you are discounting it at the spot rate, which makes sense, right? We're not discounting it at the forward rate, because we are just discounting it at the spot rate of each fixed rate payment. So based on this formula, we can rearrange the formula to make the C, which is the fixed coupon rate or the swap rate, as the subject given by this giant equation here, where R, so this is important, again I repeat, where R here, all these R are your spot rate. So I'm just going to put very big as your spot rate. Okay. There's going to be an example, so do not worry, but I just want to flip over to show you this equation which we have talked about in the last slide here. Remember this? Rearrange the spot rate to give this. Remember, I say put this aside, we're going to cover this. So this is exactly what we talk about, which is why I didn't want to talk about it in this slide, because it's good. It needs a full explanation because this is based on method 2. So this is method 2. I'll just put a 2 here, right? So method 2 uses your spot rate. Okay, let's look at example. The same example we have looked at in method 1. So returning to the example here, okay, remember the example gives you what? The LIBOR forward rate in this example. We now have to deduce the semi-annual spot rate. So this again, I'm going to put 2 stars, 3 stars here because please read the question very carefully. If you're using method 2, use the spot rate. If you're using method 1, use the forward rate. And read the question carefully to see what rates are given to you. Okay, so in this case, in this question, we are given the forward rate. We determine the semi-annual forward rate. No, this is exactly the same as what we have seen. But recall, how do we deduce the spot rate? So now we have to work backwards in terms of formula. Remember, the formula that we talked about in the start of today's lecture is determining the forward rate. But in this question, we are given the forward rate, so we can actually back test and deduce the semi-annual spot rate here. So one thing to take note, by definition, the forward rate for the first period is the spot rate, right? So it's by definition, it's a spot rate. The first period is always a spot rate because the first forward rate that we know is obviously the spot rate, right? Because that's the rate that you know now. But the forward rate in the future would now have to be used to deduce the spot rate using backwards induction. So you use a backwards deduction or induction to determine the spot rate here. Okay, just want to highlight to you something. You notice that the forward rate and the spot rate are very close. So sometimes when you do your questions, maybe you want to compare with your friend, then you compare with your friends, hey, but our answer about the same, but actually you might be getting a totally different marks. Maybe one of you get full marks, one of you get half the marks because you are using the wrong rates. So please be very careful. Read the question carefully. What do they give you? Is it the forward rate or the spot rate? Okay, and you can actually affect your answer. Now, having determined the spot rate, again highlight here, we can now very simply use the formulation given by method 2, this one, by plugging in the value where this is the spot rate at n, which is here, right? N at the end. And we plug in the various spot rates. So I'm just going to write spot again to determine the swap rate, which is your fixed rate. And can you see that? Wow, it's like almost like magic where it's exactly the same answer as method 2 and method 1. I mean, can you see that this 4.37 is exactly the same as method 1, 4.37 is like wow, it's like magic. Yeah, but it shows you that actually both methods are exactly the same. It's just that we are using different methods of determining the rates. Then the question comes, okay, okay, okay. So we have determined method 2, we gotten the spot rate, right? So to note that both method 1 give the same answer for spot rate. So we again do the same thing for t more than 0, meaning that after the first 6 months period has passed. So after the first 6 months period has passed, this is the new forward rate. Remember that was given in the question. And then we determine the new semi-annual forward rate. And then now we determine the new spot rate. And again, based on these new rates, new spot rates, we determine the fixed rate or the swap rate, which again, like it's almost like magic. It's exactly the same. 5.25. If I'm going to flip back, you see 5.25. So it's exactly the same. On this point, this is where I want to again highlight to you, if you are using simple interest, this is where both methods might give you a different answer already. So that's why for me, I again want to highlight that my preference is to teach the compound interest because it really shows you both methods having the same answer. But if you are interested, you can try using or try to review the slides in the lecture notes, the lecture group, where they use the simple interest method. And you'll notice that for method 1 and method 2, there's going to be a slight variation. I think it's around 0.03, 0.04 difference, which is not a lot because in this case, it's only 2 years or 4 compounding periods. But if it's going to be more, then your difference is going to be a lot. Okay? But if you're going to use compound interest for both methods, you're going to get the same answers. So this one is just a repeat based on the rates on the new fixed rate payment for each period. We can again determine what's the difference in the payment and recall that this is exactly the same as what we have calculated as well, right? I'll let you review this yourself. It's exactly the same. Okay. Okay. We have one last example here that I'd like to go through for today's lecture. Okay, so let's look at this valuation of the swap. So one more example. This one has a lot of information, but let's try and dissect what's happening here together. So we have a principal of 50 million. Okay, initiation date 1st of January. Assume a 30 days per a month, 90 days per quarter, 360 days per year. Okay. Young makes a payment to ABC based on a 90-day annualized SOFR based on April, July, October, and January. Note that the payment is determined by a 90 days SOFR. Okay, all right. Note that the time is 0, 90 days annualized or annual spot SOFR. So this is spot. So here I'm going to just put 2 stars or 3 stars. This is a spot donated by FL09, known that T01 is T0 is the start date. Okay, so when we see this, when we see FL0, 180, 0270, 0360, immediately, sometimes they might not even say it's a spot. They just say the rate, just say based on annual rate. Okay, this one is quite nice. They say based on spot curve. So this one have many examples trying to tell you it's a spot, 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 right? Some questions can be a bit more tricky. They don't tell you. But once you see this 0 to 90, 0 to 180, when it's 0 to 90, 0, 180, 0, 270, immediately this means it's a it is a meaning of a spot because spot is from now, right? Now is 0. So if the rate is 0 to 90 means you are determined, you know the rate of 90 days from now, which is a spot, or 0 to 180, you know the rate of 180 days now, which is a spot, right? So all this, in case this is not given to you, they don't tell you spot, by looking at 0 to 90, you should know that these are spot rates, right? Okay, so let's go to method 1, right? So method 1, recall that method 1, we need to use the forward rate. We need to deduce the forward rate. So we are given the spot. So please deduce the quarterly. So first of all, we quarter the spot rate first, divide by 4, and then you get the forward rate using the method we have taught in the start of today's lecture, right? Again, the spot rate and forward rate by definition of the first period is the same. And then we deduce the forward rate using the spot rate curve, which we have learned at the start of today's lecture. Okay. For this swap valuation, I really encourage you to redo this calculation once and set up an Excel sheet, right? Once you have the Excel sheet set up, you can simply just, it's very mechanical. You can just change the value based on whatever question and you can get an answer straight away. It's very easy, but try to set up Excel sheet based on this lecture example to ensure that your Excel sheet is correct. Once you get the forward rate, we apply the same method because once we have the forward rate, we can use this forward rate to determine now the value of the floating rate payment. Because remember, floating rate payment is based on forward rate, right? And after that, we determine the discount rate based on the forward rate and the present value of your floating rate payment. Then we sum the present value of floating rate payment and we sum the discount rate, forward discount rate factor, right? Given by here, sum. Then the method is the same. We know that the present value of the fixed rate payment equals present value of floating rate. We can then determine the annualized fixed rate for the annualized fixed rate payment for the fixed leg, or in simple terms, the swap rate as given here, right? By equating the discount rate factor and the present value of your floating rate. Once we determine the swap rate, we can prove to ourselves that actually, hey, you know what? It's exactly the same in terms of your present value of your fixed rate payment. We just simply multiply the fixed rate leg and we get this 1544474, which is exactly the same as your floating rate, 15447,474. In this question, because you are given the spot rate, it's actually quite easy to use method 2 because you are already given the spot rate, so we just use this one, quarterly spot rate, so first spot rate divided by 4, and we just plug it into here using method 2, and we get 3.15 immediately. All right. So actually that's all for the valuation of swap. Any questions? So this, of course, I'm pretty sure, yeah, this is something that will be in some form of assessment. But any questions on this? Any queries that you have to check? Yeah, so just need to read the question carefully. Like, just read the question very carefully, because the questions will try to confuse you, and make it very complex. But once you know what they're asking, are you using forward, are you using spot, what values they're giving you, then you should be okay. Just be very careful because if you think it's the wrong value, for example, in this question, if you didn't realize that, hey, you know what, these are spot values, you think these are forward because there's an F there, FL, like forward something, forward leg or something like that, you think it's a forward, your whole answer is going to be wrong. So just be very careful. Of course, you will still get method mark, you know, you don't need not worry that you get 0. But of course, at the end of the day, you still maybe want to score the full marks, right? You don't want to waste marks based on reading the questions wrongly. So just be very careful when you read the questions. What are they giving you? So the reset date, right, happens for a floating rate bond, not only at maturity, but at every step. So a floating rate bond will have a reset, let's say based on every year. So at that 1 year, you will look at the bond and price the bond at that point of time. So we call it like the reset date. And what's unique about this floating rate bond is that every time when you are at that date, meaning like n-1, n-2, at that point of time, the price of the bond is actually always the same, which is at par. It doesn't change, even though it's a floating rate bond where you will think, oh, it's floating rate, it's going to float, right? But it doesn't actually float. Yes. So it's like you can think of it at the various stages of the floating rate bond. So it's not the maturity, because maturity can be n, but it can be a set date where the floating rate bond is going to be reset. So because your floating rate, you are going to get interest, right? Interest on the okay. So this is a bit more technical in terms of bonds. So your floating rate bond, you're going to get bond coupons, right? Coupons, and this coupon is based on the interest, and because the floating rate is based on your LIBOR plus something. So it is the date where you determine your LIBOR interest in the market. So maybe your LIBOR on that day is 3%. Then the next date that you determine this LIBOR is 4%. So at every date where you determine this LIBOR is considered the reset date. So when you have a reset date, this is where your coupon payment changes. So that's considered a reset date. So, for example, if your uh, floating rate bond, because okay, so we'll cover bond in the last two lectures. I think this is the last lecture for derivative. The next one is a bond rate. So for bond, if we have a bond of 3 months so far, let's say, so every 3 months is will be our reset date where we will determine what is our new coupon rate or new SOFR rate for our floating rate bond. Okay, so okay, let's see. Yes, based on and so apply the floating. Yes, correct. So is let's say the reset date is 45. So yeah, so the whole period is 40, 90, and 45 is the reset date. So at 45, we determine the coupon payment amount, which is based on the LIBOR rate at that point of time. Yeah, and so yeah. Why does it need to reset? Is because it's a floating rate, right? So we need to know at which date will we determine the current LIBOR, right? Because it's floating non-stop. We cannot say determine the LIBOR every day, right? So there's need to be like a reset date. Yeah. So it will be reflected on the market LIBOR or SOFR at that point of time. Okay, that's a good question. Okay, so that's all we have for today's lecture. Just want to quickly just do an overview of the TMA. As you know, based on what is being disclosed on the lecture slides, this is they call it a summative assessment, meaning that you don't get back your paper, which is unfortunate because I always think that it's better to receive your paper with your comments and stuff so you can know what to improve, right? But unfortunately, because it's like a test, and so they don't want the school doesn't allow us to release your actual scripts. But I just want to do some overview in terms of the TNA. I think generally, like what I mentioned in the first two lectures, generally the class test. Wait, let me just pause the recording so because we are done with the lecture.